Welcome, it's Sarah Larby, guest host and producer of Everyday Investor, where we show you how your money can make money, whether it's stocks, options, real estate, and there's lots of different strategies. This is going to be the place for you to get your information, your knowledge, and build your team of solid professionals along the way, whether they are lawyers or coaches or people you just want to connect with. So we've got lots of great guests. Don't go anywhere. Coming up, we are speaking with Mark Baltazar from Peak Multifamily Investments, all about multifamily investing.
The light bulb for me, the main deciding factor was the multiplier, right? So the multiplier, every dollar that you increase net operating income, the value of the asset goes up 4 or 5 times.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Hey, it's Kyle from the Kyle Ford Mortgage Team. This week I want to talk about financing properties, investment properties specifically, with less than 20% down. As many people know, it's quite common to buy a primary residence with 5, 10, or 15% down. But when it comes to buying investment properties, the industry standard is 20%. At the Kyle Ford Mortgage Team, we specialize in helping investors purchase properties that are more difficult to qualify for. Often we are able to get financing at up to 90% loan to value, which is a 10% down payment, by using private money. Now, this doesn't work for everybody, but if you're buying properties that need work, have significant upside, or have a clear exit strategy, we can help you acquire with less money down. If you have questions on how this works, don't hesitate to reach out to myself and the Kyle Ford Mortgage Team.
Mark, welcome to the show. How are you?
Great, thanks for having me on.
I'm excited to talk about multifamily, one of my favorite strategies other than the BRRRR strategy, but you can still do that with multifamily. Tell us a little bit about how you got started in real estate investing to begin with.
Real estate investing, so it was on my mind for a long time. So my wife and I had planned on getting into real estate investing. My parents had, my grandparents were renting units at some point throughout their lives. And so we thought, at some point we should probably get in. I understood how it worked, and it was, understood its wealth building capacity, but sat on that idea for 5 years. And, sat on it, next year, and then, as you get older, time does move a little bit faster. And then finally decided to jump in. At the same time, I was a partner in a marketing strategy firm. So that, that kept me busy. The income was good there as well, but knew that there was a time that I would, transition out. So my first foray into investing was wholesaling, really. That was the intent anyways, to find properties and, sell them to investors.
And when was this? Like how long ago?
This was in 2014, 15.
Okay.
When I decided, okay, I need to start getting into it. So I'd say 2014 was a year of education. Mm-hmm. And so wholesaling was going to be my strategy. And so, after 4 months of trying to execute the strategy, it didn't work.
Kind of one more shot. Wholesaling is a grind.
It's a grind. It's a grind. And luckily, and so a deal came up literally 1 minute from where I lived at the time. And I'll look at this last time, and finally, I got a deal done. Didn't end up wholesaling it. A friend of mine said, let's partner on this deal. Let's flip it. I'm not a renovator. I'm not, handy with trade. So I structured the deal, got the financing. He did the work. So that was my first deal. Then we did probably about 30 flips over the next kind of 3.5 to 4 years after that. And along the way, held some duplexes, triplexes. I think the largest property I had was a 4-plex in Aurelia. And then kind of started to get introduced, or at least understand multifamily apartment buildings. And then, bought 14 units in, I guess, mid to end of 2017.
Okay.
And at that point decided, okay, I'm going to shift from the more short-term flip strategy into multifamily, and have been focused on that strategy ever since.
Yeah, and you've been buying bigger and more and repositioning them to add
Yes.
more units and all of that good stuff. Are you able to share roughly like what your portfolio consists of today? Not necessarily like how many doors you have,
Yeah.
but like, just in maybe more of a general overview.
Yeah, so we're 36 million in assets right now. It'll be 40 million or just over 40 million by the end of the year. We have something under contract right now, and we'll close maybe December, could be January, but and then we have another one going. So we're at it'll be 40 million at the end. I never thought that number can exist in my portfolio. I mean, it's and it's starting to ramp up a little bit more. And we're just executing different strategies. So it's always been run like a business. This is what I do full time. It's not a side hustle. It is it is a business, and I think once that mindset shifted, things started to grow a little bit faster, and because you're focusing on it.
Yeah, absolutely. So when did you decide to actually leave your 9-to-5 job? Was it like a couple of years into it, or just recently?
So 2.5 years ago.
Okay.
So 2.5 years ago. So there was a period of time where, and again, I was part owner of this company, and so I had a conversation with my partners and said, I'd like to work some more from home. I am doing some real estate on the side. I'd like to spend more time with my kids. I'd like to go to hockey practices and hockey coaching and stuff like that. So I started working from home a little bit more. This was probably 2 years before COVID, 2.5 years before COVID. So I was already starting to work from home,
Right.
which my office was downtown Toronto, so that's an hour and a half both
Yeah.
ways. So I was gaining about 3 hours a day at least.
Okay.
So I started to spend some more time in real estate. So I was executing these earlier strategies. And spent a lot of time, and then decided in early 2020 that I was able to leave and focus solely on apartment buildings and kind of what we're doing right now.
That's awesome. So,
Yeah.
I mean, from essentially 0 to 40 plus million in assets, that is awesome. Congratulations.
Thank you.
Somebody that's thinking, hey, maybe multifamily is the route for me. What are some key benefits that you would say, like, these are the benefits, and then what are some like maybe more challenges to multifamily versus singles and smaller 2-3 units as an example? Because when when you're talking about multifamily, you're talking about big buildings.
Yeah, they're I'd say medium size.
Okay.
So they're commercial, commercial specification or characteristics. So they're 5+ units. The ones we're buying now are anywhere from 15 to 20 and 30. We have 30 units. We're going after 30 units right now. And so the big for me it was mortgage qualification. So that was one thing, not the only thing, but the qualification for mortgages is different.
Yeah.
Right? So it's not necessarily on your personal income. It is more about the asset. The light bulb for me, the main deciding factor was the multiplier, right? So the multiplier, every dollar that you increase net operating income, the value of the asset goes up 4 or 5 times, depending on the market, depending on the cap rate, etc. There's a whole math behind that. But to me, that made a lot of business sense. If you're improving an asset by a certain number, that there should be a multiplier, like any business gets valued. I thought the multiplier for multifamily was pretty healthy, given the work that was being done. And so that was, and you don't really get that in single family
right,
so
because
much.
it's based on the comps of what's sold in the area
Right.
recently
Yeah.
and all that stuff, versus, like you said, if you're creating a higher net operating income by either increasing the rents
Yes.
or
Yeah.
whatever other income there is, or decreasing the expenses, that helps your NOI, which essentially, based on the cap rate, is
Yeah.
what is the value of the property.
Yeah,
Because you can have a 10-plex with a 10-plex across the street, and
100%.
they could be worth millions potentially of different, like hundreds of thousands of different value based on one
absolutely.
producing very little NOI, and one can
Yeah.
be like a cash cow.
And you look at it even right now, the residential market, there's some flux, there's some variability going on. Everyone can see it. In commercial, it's not that, you don't see that. You don't see those ups and downs. At least multifamily, there's other asset classes in commercial that do go up and down like that. But there's a little more confidence and stability. So I think for those that are looking for stable assets, especially in a time where things are moving up and down, stock market as well as residential real estate, it becomes a nice it's boring and stable asset class, which is, okay.
There's nothing wrong with boring and stable.
That's right.
What are some potential downsides, though, that you can see maybe a new investor struggling with?
There's, I think, initially the size, right? So it requires more capital. The mistakes, if you do make some, and I made a lot of mistakes in the beginning, still make mistakes, you always learn from them. They're a little more costly, right? So I think the sheer size of the deals and the capital required to buy these assets is larger, right? So it may take someone longer to buy maybe a 10-unit building than it may a duplex or a couple duplexes. So that is a downside. You're dealing with now multiple tenants, right? So if someone's used to not dealing with tenants or perhaps dealing with 2 tenants, now you're dealing with 10 units. Maybe there's 2 people per unit. There's 20 tenants. So just the scaling size and dealing with more stuff that's going on can be scary for people at first. But there is always a solution. There's people that are doing it now that you can collaborate with. There's property managers, professional firms that you can hire to help you manage these things. So those are a few of the things that get brought up when we start to talk to people that are just looking to get into it.
Okay, so there's ups and downs and the pros and cons of every single strategy. I think it's a great strategy. What I like that you're doing is that you're kind of repositioning these properties, right? Because a lot of them probably aren't great deals when you're acquiring them, and then you make them good deals. So walk us through what that even means.
So we're buying assets that are typically 40 to 50 years old. There are some in the portfolio that are newer, but 40 to 50 years old, sometimes 60 years old, that have not been maintained, right? The common areas haven't been maintained, still dealing with, fuse panels, old, dirty, smelly carpet in the hallways and such. And so buildings like that attract a certain type of tenant or attract a level of rent that's, associated with that kind of unit. And so what we're doing is buying those and renovating as many as we can, and increasing the revenue or the net operating income by renting it to tenants that are looking for, our positioning is condo quality rental units. Some of the buildings, may not have the amenities such as pools or weight rooms and such, but the unit themselves, they're self-contained units. They have in-suite laundry, quartz countertops. They're renovated to condo quality. And so people are willing to pay for that in the markets that we're in.
Okay, and then you're essentially able to create that new net operating income over time. Again, not everyone's moving out in a year from now, 2 years. It takes time to do those. And I do want to dig more into, how that all works.
Sure.
We will be back soon, so don't go anywhere. We're going to bring Mark and we're going to actually dissect a deal that he's doing right now, but talk more about the strategy because I think it's fascinating. So we'll be back soon. Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage Team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage Team today, Canada's mortgage choice.
Hey guys, Lee here from Wise Construction, bringing you your winter tips to get your homes ready for the change of season. So it's a good time now to look at your furnaces, look at your dryer vents, look at everything to kind of seal up your house, change your filters, get your furnaces cleaned out, get your dryer vents cleaned out, kind of get your home switched over for winter. It'll be much more energy efficient. Your home's gonna run better, feel better, breathe better, and be cleaner. Any questions, please feel free to reach out to me.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more.
Welcome back. We are speaking with Mark Baltazar about multifamily properties and how he is taking underperforming assets and really creating something condo quality wise and providing more value to not only the tenants renting, but also value in his pockets for himself and investors. So, let's go back to that strategy a little bit, because I know at one point, we've talked many times on this, but you were also looking to see if I think a building can be added with more units, or you can increase units in a building, rather, I should say. How does somebody determine that?
So I guess there's a few ways to add units. One, within the physical structure, or adding on top, or perhaps on the property. So currently have 3 projects underway right now where we're trying to add units within the same physical structure. So we're not increasing the surface area of it. So when you're walking through, we're looking at, is there wasted space? So in this particular building in Hamilton, it's an 18-unit building with car park garages, large laundry room, some storage, and a really large mechanical room, so where they keep the boiler or the furnace system, hot water tanks, all that stuff. And so there's a lot of space there, a lot of wasted space. And again, the name of the game in this strategy is to generate more revenue at a rate that's greater than your expenses are increasing, so net operating income. And so we feel that there's an opportunity here to add units. So we have committee of adjustment approval, or committee approval to proceed with the addition of these units. And so it's you're walking through, and if it seems like there's a lot of space that's not being utilized, the question people should be asking themselves is, what is the best use? What's the highest and best use for the space, right? Can that space be used to generate incremental dollars? It could be an additional rental unit, it could be storage, it could be, maybe it's parking, charge for parking. So
let's actually dissect that deal more specifically. So what is the purchase price of the deal? How did you find the deal? Was it on market or off market?
So this one was off market.
Okay.
So this was direct to seller. And I think I would say the people that are in this strategy are looking to invest or purchase on their own is to look at all avenues, right? It could be off market, MLS, working with brokers. This one particularly was an off market deal, so direct to seller. And we purchased for $2.9 million, 2.960 exactly, in January 2021.
So 2.9 for how many units?
18 units.
18 units. Okay. So back then, was that on the higher side of the market? Was that on the lower side of the market? Or was that kind of just?
The price was good. If you look at a per door price, it was good. What made it a great deal is that we knew that there was opportunity to add units, and we knew that there was an opportunity to change over some of the tenants, because some of the tenants were disgruntled because the prior management just they weren't keeping up with some of the aspects of managing a building. So we knew that they were on their way out. So the opportunity that lied ahead was significant enough that made this a really good deal.
I think that's all the extra stuff that maybe a lot of buyers aren't seeing. That could be very valuable if you're able to exactly see that space and be able to add those units. So how did financing work on something like this?
So on a deal like this, typically, so we have a two-phase strategy, a two-phase financing strategy. First, for the first anywhere from 12 to 24 months, this one will take 24 or about 18 months to do, is we take out what's called bridge financing. And bridge financing, it costs a little bit more, so the rate is a little bit higher. They're a little more flexible in terms of their loan to value and what they're going to lend on the property. And typically we work with lenders that understand the strategy. They understand that it takes about 12 to 24 months to do this kind of work. They understand that you're buying an asset that's underperforming today, and they're comfortable with the business plan to improve the net operating income to increase the value of the building. So we purchased with 85% loan to value.
Okay, that's awesome.
Which is really good. And this was during a time where interest rates were lower than they are today. The strategy still works. You just have to be a little more careful with that type of strategy. And also the other aspect that working with this, we've worked with this lender probably 5 times now. They also provide construction financing. So that's a big benefit because you don't have to put extra capital in for equity. So it really reduces the amount of equity you put into a deal, which in the end, again, you have to be comfortable with that level of risk.
Yep.
Your ROI does get boosted because you're putting in less to generate a similar amount of profit in the end.
Yeah, absolutely. I mean, we did one recently where 100% of our construction financing was covered.
Yeah.
And same thing as you, I think we had 80% loan to value. But they're still great numbers because you think, okay, these are potentially $1 million of reno money. But again, the deal has to make sense. You've got to you have to analyze and analyze again and ensure the numbers work and have the team around you. So your down payment essentially was 15% of the purchase price. What are closing costs? Because these deals are quite different, right, than buying a single family house or residential, under 5 units, essentially your 1 to 4 unit property.
Yeah.
There's different types of costs involved. Can you walk us through some of that?
Yeah, so the line by line closing costs, I don't know exactly, I don't remember exactly, but in total it was about $265,000, and that included a whole bunch of things. Land transfer tax, right, which is fairly hefty on these types of deals, double in Toronto if you're buying in Toronto, 0 in Alberta if you're buying in Alberta. Legal costs. We also, in that soft cost, there's appraisals, right? So appraisals for a building like this is probably about $4,000. Inspector reports, another $3,500 or so. Environmental assessments, so another $3,500 to $4,000. So in total, with fees and professional fees and legal fees, land transfer, closing costs, about $260,000 to $265,000.
Yeah, and I think that's what sometimes people don't realize is like the costs are so much more. Like you're talking about, $4,000 for an appraisal. I think we've spent once on one building $7,000, and the other one was like $5,000.
Yeah.
These are more costly, and actually they take a lot longer to get done, right? So it's not like they're going to give you the report back in 2 days.
That's right. Yeah,
how long would you say somebody should expect that appraisal to come back from a commercial building, like something similar to what you're buying?
We ask for 2 things. One, can you give us a preliminary idea fairly quickly, just so we know if we're in the ballpark, and we've been in the ballpark all the time, and then a final report. So I say the final report is anywhere from 4 to 6 weeks out.
Yeah, absolutely.
Depending on what's going on, probably a little bit faster on the lower end now because there's fewer deals being processed. But at the height of let's say beginning of 2022, it was 8 weeks sometimes.
Absolutely. So you got to keep that in mind in your conditions, right? So if you're out there thinking you're going to close in like 30 days, you're probably not going to have the appraisal back in that time frame, right? So what about the renovation? So talk to us about like the total renovation cost to do what you wanted to do.
Sure. So the strategy for this one, so again, 18 units, really a 2-phase strategy. We're on phase 2 right now. Phase 1 was let's renovate as many units as we can within the 18 unit block. Renovate them, put new tenants in there. So our original plan, I believe, was we were going to turn 13 units in 2 years. Just as of yesterday, we're now at 18, so we've turned 100% of the units. But we did refinance about 2 months ago. So we refinanced with 16 of 18 units turned. Our budget was just under $50,000 per unit. We ended up spending a little bit more, probably about $52 to $53 per unit, because costs, labor, all the stuff that's happening right now. Costs were a little bit higher, and then some common area costs. So we're probably at about 900-ish or so, kind of 900,000, 900 to 950,000 right now, and then we'll have another. So again, we'll add another 5 units. We'll spend another $600K in adding those units. But up to today, we're about 950,000.
Okay. And what did your first refi come back at?
So we refinanced so it was appraised at $6 million.
Okay.
So less than 18 months after purchase.
That's awesome.
Yeah.
Congratulations.
So, yeah, no, it was good. It was good. And I think it's a great number, we were expecting more, but in the current interest rate environment, they did
And the
take
cap
things
rates
off.
change a
Cap
little
rates
bit.
changed slightly. So the $6 million is good. I mean,
Yeah.
we basically
Yeah.
doubled the value in 18 months. It's really good. And so we did another bridge. We did basically a bridge to bridge because we knew we still had another 5 units to go. We wanted to pull out some equity and then buy another building with that. So we were able to get 80% of the $6 million, so about $4.8 million out of that, which paid off our first construction financing, as well as all the capital that the majority of the capital that we put in. I think $800,000 was put into that deal. We were able to take out $600,000.
Okay, so you're pretty much out of the deal entirely, minus a little chunk of money. So it's almost like an infinity return in the sense that you are not you bought this building. Yes, you had to put some money up front, but you were able to pull it back out.
Yeah.
Did you do anything? And again, probably a bigger topic, but did you exit with CMHC? And did you use the MLI Select program, or was that not available back then?
So we are going to do that. So basically we did a bridge. So there'll be essentially 3 mortgages over the course of the, let's say lifespan, but let's say over a 6-year period in this project. First bridge, we just exited with another bridge just to again pull out equity, buy more assets, and fund the rest of the renovation. In 12 months, we will refinance with CMHC, MLI Select program. We've already had the engineers through there to give us, give a baseline. I mean, you're right, it's a whole other topic.
It's a great program. And I would just say, if you're at home thinking, what is this? It's essentially a way that you could earn points based on the fact that you're making you're building more energy efficient, that you are creating accessibility, and potentially some units that are less than market and all those things, and it adds the points. But what that does is a higher amortization, better loan to value, lower rates, and more cash flow. And so I will say, look, this is definitely a bit of a more advanced topic, right? And so if somebody who's watching this show wants to know more, do you offer any coaching or anything like that they can essentially get more access to what we just talked about?
Yeah, so we do one-on-one coaching. We recently held a mastermind for those that are looking to grow their business in multifamily. This is kind of what we're focusing on. And then there's on our website there's tons of resources. In fact, we have a webinar with one of the large lenders in Canada about MLI Select, how to execute it. It was basically recorded right in the beginning of when they launched, because they launched March 2022. So, but yeah, no, we help people kind of get into it. And the interesting thing, so I think the learning, after coaching a number of people and running masterminds about this specific topic, it's all up here. And you deal with people that have achieved so much, sold businesses, have very large single family portfolios. We have one gentleman, he has probably 600 units in apartments. They're all large, like 100-unit builds. He's had in his family for a long time. But it's now buying new stuff, and it's like they've done amazing things, but it's getting into something new, and it's all mindset, and that's really where the work is. It's the mindset. Like everything else, there's financing. We have lenders and brokers and agents that can help along the way, but the big battle and the big, I don't even say obstacle, but hurdle to overcome is all in the mind.
95% of success in real estate is mindset. I truly believe that. I know we've read it probably in many books and many things. And Mark, thank you so much for being on the show, providing some great insight. Pleasure. I think this is a very interesting topic for people that are, a little bit experienced, or you could still be new and do very well. Absolutely. But if you have a couple properties, or you're like, how do I get to that next step? This could be a strategy for many people that want to really scale at the next level and create some good cash flow along the way. So thank you so much for being on the show.
Pleasure. Thanks for having me.
And don't forget to tune back in next week. We have a brand new show for you. And don't forget to also reach out to our guests on the show, because they can provide lots of additional great value as well, even after today's show. So thank you very much for tuning in.